Welcome to the Elevated Trader Podcast. I am Dr. Kristen Kidgel.
And I am Tracy Ball. Join us every week as we journey into becoming better traders.
We believe becoming better traders involves elevating our skill, mindset, and our health. In each episode, we will discuss the current book we are exploring, and we invite you to join us on this journey.
Are you ready to elevate your trading, mindset, and health to the next level? Let's do this.
Welcome back, Tracy Ball.
Hello.
Are you ready for part 2 of the book Candlestick Charting Explained by Gregory Morris?
I sure am. I gotta say, I had a hard time stopping.
She was geeking out, you guys.
I was geeking out. I love the stats. I love statistics.
Yep, we thought it was going to be War and Peace. It's really thick. It's probably more than an inch at least in thickness, but there's a lot of graphs. So, and data boxes. So that's not so bad. So before we talked about reversal patterns and a little bit of the history, and now we're on to what?
Continuation patterns, the Sakata's method, and the philosophy behind candle pattern identification.
Okay.
That's really the 3 chapters.
You want to start with what stood out to you?
Well, again, when I'm looking at these statistics, there's nothing that is standing out to me that's saying, ooh, this is a really good pattern. I better trade this. It feels very arbitrary. It feels very 50-50 for the most part for all of these. And again, I'm a little disappointed that, well, I'm not disappointed. I should say that the candlesticks, as we mentioned before, you match that up with something else. You put that into, you can't just take them on their own. I don't think you can take them on their own. I think that based on the statistics, it's just it's a 50-50 shot. But that being said too, risk reward, I don't know if we've talked about this before, but risk reward should always be going for more than a 1-to-1 ratio. And that's how you become profitable as a trader, is always winning more than you lose. So in order to do that, you have to make sure that you're winning more than you lose. So if you're setting up trades and you're going off of statistics like this, where you have a 50-50, you better be winning more than you lose, right? Otherwise, you will be break even or losing, and that's not a good sign. So take this in, look at it. I think that the patterns, they're good for you to become aware of, but I think that it needs to be in conjunction with something else. You have to be able to match it up with either another indicator or with support resistance levels, however you do that, but it has to be matched up with something else.
Yeah, so the author does say that out of the get-go.
Yeah.
Right in the first chapter. Matter of fact, in this part, they do go into other technical analysis. They do talk about the trend constantly. And it's very common that they do, when I say they, the author, in the data and in the stats and everything, it's like, do you need confirmation? Yes, no, required or whatever. One of the things I think that stood out to me, I actually went back and read it a couple times, is like, even though this first part of this is continuation patterns, it says basically it's a time of rest in the market, and it's a time to make a decision, on your trade. So even if you don't make a decision, that's making a decision. So I added that part. What I found interesting, it's, again, if you think about particular patterns, whether these were usually a single candle, 2 candles, 3 candles, there's even a 4-candle pattern, but it is all in reference of like the bigger picture. So some of the ones that stood out to me were, there's one that's called separating lines. And I don't know if I've ever heard that term. Some of these terms I've heard, but I don't think I've heard that one. And that can be either a bullish one or a bearish one, but it's when they have the same close and the same open. So I feel like we probably see that more often than we think we do. But again, we have to also remember that they're talking about daily candles, but you and I are like, well, these patterns can show up anywhere.
They can.
The other one was a 3-day pattern or a 3-candle pattern called I'm gonna butcher this. I hope I don't butcher. I'm gonna try to pronounce it. The Tasuki gap.
Oh yeah.
And then there's an upside and a downside. I feel like we see that one probably a lot. because there's a gap and then there's like this rest, but then there's a
And
continuation
yet it says it's
of
rare.
the,
It says it's very rare.
it's
Yeah.
rare.
But yeah,
This is interesting.
it
What?
feels very common because I feel like I've seen that, but maybe we haven't. We'll have to go back and take a look at it. So yeah.
Yeah. The other one that I feel like has been mentioned a lot in my time as a trader is rest after battle.
We actually talked about that today. Rest after
Yeah, I
battle.
thought that was funny that you had mentioned that this morning.
Yeah.
And then just a little bit of history. I think that is interesting, if anything, is that they do particularly think that this particular guy is really important in the history of trading. I don't believe he's the first trader, but that he wrote a book
Hmm.
back in 1750. I call him Mr. Homa, Homa. You had mentioned in the last, episode about the
Yeah.
rice. He was exchanging rice. Rice was the big like original trade, but he was really interesting because for some reason he was probably like you, where he started keeping records about trader psychology.
He must have been
The other
wealthy
thing
though. He must have been wealthy because he had over 100, at least 100 people that he had employed to keep track of the data for him. So because he had them on rooftops, like actually physically down the way watching the rice movement throughout the area. But anyway,
I just can't imagine it. And those were his employees,
yeah,
right? Yeah. So
yeah.
they're in. So I found that
He was a
fascinating.
he was a feudal
I mean,
lord, right? I think that's what he was. So he must have been wealthy.
well, whatever that
Yeah,
means, we're talking like early 1700s.
yeah,
I mean, come on.
yeah.
So, what else did I have here? I thought that was interesting. Oh, he's known to say if you feel compelled to rush into a trade because you feel you just can't lose, this is wait 3 days. So, if you still feel the same, then you're likely right. But I do think the old having patience is interesting.
It's interesting because there's a lot of patterns that are 3-day patterns, and it makes sense because those 3D 3-day patterns start out with a single candle pattern sometimes, and that second candle can look like looks good, but maybe it doesn't look good. But that third candle, once you get that third candle in, it actually completes the pattern and makes it look more promising. So vice versa, right? It's whether it doesn't look good or whether it does look good. That 3 days can make a huge difference. And there's a number. I think they mentioned that there's a thing with the threes, like everything comes in threes type of thing. That's a number from that tradition. I think that is quite common.
So, little history note for like if we decide to travel to Japan, his house is a museum now.
Yeah, I know. It's not cool.
I don't know, man. That's just like,
That'd be something to look at. I'd definitely be up for
I
that. Yeah,
know.
for sure.
Like, what are we gonna see? Are we gonna see like his journals laying
An
around? Did he
abacus.
like, yeah, like what is his house? What is it
Oh,
like?
that'd be cool.
So let's see here. Well, this is interesting. You're talking about stats. One of the things he goes on and on and on and on. There was a point where I was just literally in the side of the book. I put a question mark. I'm like, maybe Tracy will go into this. I just can't even get all these equations that they're talking about. It's just way over my head. But the reversal patterns were showing up 74% of the time. And I thought that was fascinating
Yeah, and we can't say
because I
that
was like,
it's due to, just a short time in the market, because this was over 17 years, I think. They accumulated data, so I'm pretty sure they had multiple bull bear markets inside that 17 years. But yeah, I think what happens is that the reversal patterns, you know, you said the statistic was 74% success? Success on reversals?
no, visualized, not success
Oh,
or not successful, but
they
those particular
you'd
patterns were
see
showing
them.
up
Yeah.
the most.
Yeah, and I think that makes sense because you've got moments where people are going to be, I mean, it's resistance. They're going to be selling. It makes sense to me. You're always going to have people that are taking profits, right?
I was just kind of seeing here, it says reversal patterns occur about 40% more times than continuation patterns. This too is important as it indicates the reversal of a trend caused by changed positions in trading. In this analysis, there were 65 reversal patterns and 23 continuation patterns, which makes reversal patterns account for 74% of all patterns.
Yeah. And like I said, it makes sense because, and when we're talking reversal patterns, that these could be short-term reversals. It's not long-term. It's not all of a sudden the market goes up and then it completely tanks. These are reversal patterns that show up. And like I said, it makes sense because the market just can't continue to go up. Just like it can't continue to go down. It ebbs and flows. It ebbs and flows. It ebbs and flows. So it makes sense that you'd have a lot of reversals that show up, right? Selling and then buying, selling and then buying, selling and then buying. It happens.
So we only have one more part after this.
We do.
What are you getting out of this so far?
Well, I mean, I like the statistics. Like I said, I like to see the statistics. What I am, I guess, reaffirming is that you have to take the candlesticks and not every candle is created equally. And that's the case. So you can look at hammers without considering the location. You can look at hammers without considering the liquidity and all that kind of stuff. But they're not equal. They're not all equal. So the sentiment behind it is a little bit different based on the location and based on the liquidity, the number of people that are participating and all that kind of stuff. So I think that it just reaffirms, like I said, that needs to be looked at. And then the other thing that I mean, really, you could probably take all of these patterns and break them down into two basic patterns. Mm-hmm. That's it.
Is a hammer one of them?
A hammerish. So you've got a buying or a selling tail, like a long buying or selling tail, or you have a great big giant long bullish candle or a great big giant bearish candle. That's what all of these patterns, when you combine them, that's what they end up being. And I think that really simplifies things, right? I guess the trick is being able to see the smaller time frames and accumulating them together in your mind so that you can see what that single pattern. But if you can practice just those two basic patterns, which is the selling tail, buying tail, or the Mariposa type candles, then you've mastered the markets as far as I'm concerned.
Interesting.
Right? So.
Yeah, he does kind of go over the importance of gaps and moving averages. So
yeah, on a daily scale, I think that's important. Intraday, not so much. So we're not going to have gaps inside the intraday, and you have to make some changes in the candles. But like I said, it really breaks down to two very different types of patterns. So you've either got that real start and finish with no change in between. The control was completely on one side, and then you have the reversal type candle, which is the selling wick or the buying wick on the bottom. When you have that's a reversal candle. Really
interesting.
What are you taking from it?
It's interesting that a lot of the ones that are popular we've heard before. Mm-hmm. The people that teach us talk about these, and then obviously they've learned them from somewhere. I'm fascinated about the history of how long it's been around. I mean, that's just crazy, the amount of years that this basic stuff that we look at day in and day out is still used today and computerized. And he did go into the computerization, how it takes out the psychology and, like how much do we read into that? And I think that's why they went into the moving averages and such afterwards. So yeah, I think it's good. I think the gaps are really good to look at before you go into intraday.
Oh yeah, for sure. You definitely want to be doing that. And because one of the things that he did say that I thought is important to note as well is in the first few minutes of the trading day, a great deal of overnight emotion is captured. So that gap plays into that emotional, the emotion of the overnight. So it does get captured in the first few minutes of the trading day. And then who knows how it'll play out for the rest of the day, right? That first hour determines that. But anyway, that's pretty much it. So that's what I'm getting at. Yep. Love it. Look forward to reading the rest of it. Like I said, I had a hard time stopping, so I just kept going through. I was like, oh, whoa, wait a minute! I passed our target. So I'm gonna go back and reread what I had already read because, like I said, it was really intriguing. And we'll catch you guys in the next episode.
Thank you for joining us today. For more information about the show, as well as our list of current reads, check us out at www.tracy-lynn.com. theelevatedtrader.com.
Remember to subscribe and share if you found value in today's episode. See you next week.